Alright, so welcome back to another video on how to secure yourself, specifically looking at the beginner guide to financial statement. So here, right, by looking at this website, when the SEC, the Security Exchange Commission, uh, tells you here that if you're able to read nutritional label, or if you can read the nutritional label or baseball or soccer box score, you can learn to read basic part of financial statements. And if you can follow a recipe or apply for a loan, you can learn basic accounting. And the basic, they're not difficult. They're rocket science. So this section is designed to give you some basic understanding of how to read this financial statement, similar as a CPA class teach you how to perform a basic cardiopulmonary resuscitation. But looking at this won't make you an accountant, much like a CPA course won't train you to make you a cardiac doctor. However, it can give you some confidence when you're able to see at a when you're able to look at a set of financial statement and make sense of it. So this financial statement, they show you the money. After all, that's what they do. So they show where the money company came from, what is it now, and where it went. So there are four financial statements. Balance sheet, it shows what a company owns and what it owes at a fixed point in time. The income statements show how much money a company made and spent over a fixed period of time. Cash flow show you the exchange between the money exchange between the company and the outside world. And the statement of the shareholders show you is a change in interest in the shareholders, again over a period of time, and the same for cash flow. So now when I look at the balance sheet, that after all they show you is the company assets, liabilities, and shareholders. So assets are anything that a company owns that has value. So they're typically can be either to be sold or can be used to make products and service. So you have tangible asset and intangible assets. So in the first, you have a thing that you can touch. So for example, land, property, machinery, tools, inventory, an intangible tool, which is trademark and patent. So right now I'm creating my trademark here by recording myself in this learning process as a social proof. Also, cash is another form of asset, asset, and investment a company make as well. Liabilities is the amount of money that a company make. Liabilities is the amount of money that a company owns to others, whether is for example, obligation that needs to pay to their employee, payroll, the rent for use a building, a loan from a bank to launch a new product or service, tax owed to the government, environmental cleanup costs, or any obligations to provide good and service in the long run. And the shareholders' equity is it's also called the net worth or the capital, but it's the amount of money that a shareholder would receive if all the company assets were liquidated and pay off all of his liabilities. So knowing this, okay, the concept. Now I look at how can we set that up on paper so we can visualize that, the layout. So sometimes By following the formula, assets are equal to the liabilities plus shareholders. You might find that some balance sheets have all of the company listed on the left side and the liabilities and the shareholders on the right side, or all the asset on top followed by a liabilities and shareholders equity. And the assets are generally listed based on how quickly they can be converted to cash. So for example, things that a company expects to convert to cash, like inventory, okay, within a year. So you have current assets, which are that, uh, or non-current assets, which are things that a company does not expect to sell, or it will take longer than a year to convert that into cash. So in there you have something called fixed assets, which are not for sale or to convert into cash because it allows us to operate the business. And then you have liabilities, where again this is here they're generally listed based on their due dates. And you have short-term interest rate or obligations that a company expects to pay off within a year, or long-term, do more than 1 year. And the shareholders, where shows the amount of money owners purchase from the company stocks plus or minus the company earning or losses since inception. So this is that some companies may redistribute their earnings, and they call that dividends. So the TLDR from balance sheet is that it shows a snapshot of the company balance, a snapshot of the company assets, liabilities, and shareholders' equity at the end of a reporting period. So it might be quarterly or annually, right? Most of the time you find in those two formats. And then, but this doesn't show you is the flow of in and out of the company. So the flow of money in and out of the company. Income statements is another type of statement that show is how much revenue a company made and the associated expense and costs that are deducted from it to earn that revenue. So at the end of a reporting period. So the TLDR, in other words, the income statements show how much revenue a company made and expense and costs deducted from that revenue at the end of or in a Jesus. It's because I just want to speed up that. So chill with it, chill, chill. Okay. Um, so this income statement show how much revenue a company made and the associated cost and expense with earning that revenue in a period of time, quarterly or annually. So at the bottom of this statement, they usually call the bottom line. You know if the company, how much money a company made or lost. EPS is also a thing that is reporting that indicate uh, how much money a shareholder will receive if all the company earnings were distributed. Companies almost never do that. In fact, they reinvest that on their business. EPA stands for earning per share. So how to know how the income statement is set up? Very interesting question, because with that we can think of them as a set of stairs. So you start at the top with the total amount of sales made from product or service, and you go one step down, and each step you make an deduction from expense or cost associated with earning that revenue in that accounting period. Again, quarterly or annually. So at the top, we begin with something called the gross profit. All right, and they call gross because gross revenue, and they call gross revenue because deduction has or expense has not been deducted from it. So there's some amount of money that a company does not expect to collect. So, for example, sale discounts or merchandise return. And once you deduct that from the gross revenue, you reach at the company net revenue. And you can think of it as a net because the revenue are left in the net after the deduction from returns and allowance have come out, right? An allowance is any obligation or any amount of money that a company needs to pay off for a product or service, or for example, allowance can be also seen as sales discount as well. Uh, Once you move down, all right, after the company net revenue, there's a series of expense you have to do, and most of the time, typically, you will find is the cost of sales, which indicate how much money a company spend on uh, making the product or service. And once you deduct the cost of sale from the company net revenue, you arrive at the gross profit, right? And they call gross profit because there's certain expense that have not been deducted from it yet. The next section show is operating expense. Expense that a company needs to support their operations, such as administrative salaries, the cost of researching new product and service, marketing, and this is different from the cost of sale because operating expense cannot be linked directly to the production of good and service to be sold for the company. So once you subtract the operating expense from the uh, gross profit and also the depreciation, which it takes into account the wear and tear, the amount of use and damage of certain assets, such as machinery, tools, equipment, in which they will use in a long term. So company spread the total cost of these assets over the period they are used, and spreading the total cost of these assets over the period they are used is called depreciation or amortization. So, for example, one way to calculate that is through straight line depreciation, right? Where you, for example, if you buy a laptop for 1,000, you then discount certain amount that is depreciable from that, perhaps $50, right? And then that amount is what you're going to divide for the number of useful years. Let's say 5 years. And then you reach to the amount of money that you're going to deduct every year. Again, this is the most simple example of how to calculate depreciation. Okay. And again, calculate depreciation is something very variable because, for example, in more stable economies, you might use that formula. But for hyperinflation economy, depreciation is uh, can be or not an asset, and is calculated different. So again, things are never black and white. Always play devil advocate with yourself. But in any case, now that I look at the depreciation, all right, and once you deduct depreciation and the operating expense from the gross profit, then you read at the operating from income, right? Something they call the operating or income from operation. Before, so you arrive at the income from operation or operating profit before interest and income tax expense. So before interest and income tax expense. Mhm. So after you deduct all operating expense, including its depreciation, from the gross profit, you arrive at operating profit or income from operation before interest and income tax spend. So interest, next company must account the interest, income, and interest expense. Interest income is the money. So next company must account the interest income and interest expense. So interest income is the money company. Yeah, interest income is the money companies make from keeping their cash in interest bearing saving account. Money market funds and the like. And this is something interesting because I didn't know what is this money market fund, and well, they exist. But to keep it short, okay. So after the income from operations or operating profits, okay, which are the deductions like operating expense and depreciation from gross profit, you arrive to that before income and before interest and income tax spend. So next company must take in account their interest and expense, or the interest income and the interest expense. So interest incomes are the amount of money a company make from keeping, exactly, this is something important. So interest income is the amount of money that a company make from keeping their cash in interest bearing saving account, money market funds. And money market funds is, for example, this money market funds involve the purchase involves the purchase and sales, those two actions, okay. So money market involve so money market involves the purchase and sales of large volume of very short-term debt products, okay. This involves is the purchase and sale of so money markets. So the money markets involved. I need to look at an example of. Well, I know an example. I know an example of this. They mention here this exact. So this money market, mhm, the money market, okay. So the money market, so the money market involves the purchase and sale of large volume of very short-term debt. Okay, very short-term debt products such as overnight reserve or commercial paper. The idea here is to get high liquidity. So the idea here is to get high liquidity. Though not quite as safe as cash, money market funds are considered extremely low risk on the investment spectrum. A money market fund generates income, taxable or tax-free depending on its portfolio, but little capital appreciation. Money market funds should be used as a place to park money temporarily before investing elsewhere or making an anticipating cash outlay. They are not suitable as long-term investment. So typically, this is an instrument, a financial instrument. This is a financial instrument that can be used as a place for park money temporarily, and they're going to use this. So money market, okay. So money market involves in the purchase and sale of large volume of very short-term debt products, such as commercial papers or debt from or risky debt from companies or reserve, overnight reserve. So money market funds should be used, according to Wikipedia, so they should be used as a place to park money temporarily before investing elsewhere or making an anticipated cash outlay. They're not suitable as long-term investment. Okay, cool. So, uh, typically a money market, which is a debt-based financial instrument, it invests on bank acceptance or short-term debt from commercial bank, certificate of deposit, bank issues savings certificates with short-term maturity. Okay, bank issues savings certificates with short-term maturity, commercial paper, unsecured short-term corporate debt, and repo or short-term government security. Yeah, short-term government security, the U.S. Treasury. So short-term government debt issue. Okay. So the TL for the TL for money market. Okay. So money markets involved in the purchase and sale of large volume of very short-term debt, such as short-term debt product, such as interest, such as commercial paper or um, overnight reserve, right? And they should be used, according to Wikipedia, as a place to park money temporarily before investing elsewhere. Okay, so this is one use case. Okay, this is one use case. Mm, this is one use case. And these money market funds typically invest in sh- uh, sh- invest in short-term debt, right? Or this money market fund is a debt-based financial instrument, okay? And they typically invest on bank acceptance, short-term debts by commercial banks, okay? Short-term debts by commercial banks, bank issue savings certificate with short-term maturity, commercial paper, or unsecured debt, short-term debt from companies, or short-term government debt. Okay, but the whole idea is to park money, or according to recipe, that they should be used as a place to park money temporarily. Okay, temporarily. All right. So once I know this, so once I look at this, that next company must account for interest income. Okay. So next, companies must take into account the interest income and the interest expense. So interest income is the amount of money a company made from keeping cash in saving accounts, money market funds, the purchase and sale of large volume of short-term debt products such as commercial paper or overnight reserve, and they should be used to park money. They should be used. They should be used as a place to park money temporarily before making an investment, or before investing elsewhere, or making an anticipated cash outlay, or making an anticipated cash outlay. Mm, outlay. Or making an anticipated cash outlay, and they're not suitable for long-term investment. An anticipated cash outlay, interest, and they should be used as a place to put. They should be used as a place to park cash or to park money temporarily before investing elsewhere or making an anticipated cash outlay, and they're not suitable for as long-term investment. But again, here is described what is the use of this type of fund or financial instrument, which is a debt-based instrument. Okay, so typically these money market funds invest in bank acceptance, short-term debt from commercial banks, uh, certificate of deposit certificate of deposit, they issue savings certificate for short-term maturity, commercial paper, unsecured short-term corporate debt, and repurchase agreement, repurchase agreement. So short-term government debt issue. Mm, all right. Okay. Noise. 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 Okay, so to recap, so after I look at, or after uh, deduct from gross profit, after deduct deduct from gross profit, operating expense, And depreciation, you arrive at the operating profits or income from operations before the interest, uh, before the interest, before the interest and income tax spends. So, mm, company must account the interest income and interest expense. So interest income is the amount of money that a company makes from keeping their cash in a saving account, money market fund, or the like. A money market fund is the purchase and sale of large volume of very short-term debt products such as commercial bank and overnight reserve. And then should be used as a place, according to investment, as a place to park money momentarily before before investing elsewhere, or uh, yeah, before investing elsewhere or making an anticipated cash outlay. They are not suitable as long-term investment. An anticipated cash outlay. That verb, I barely use outlay. Mm, outlay. What is it? Is it a noun? A verb? It's a verb. Verbal expression. Verbal expression. Yeah, it's a verb. Outlay. Outlay. Mm, in financial expenditures. An outlay. Amount spent. Mm, amount spent. Outlay. How much you outlay? Or how much you spend? Mm, outlay. Interesting. In Spanish is desembolso. Outlay. Very, very interesting. Mm, okay. Mm. So these money market funds involve the purchase and sale of large volume of very short-term debt products such as commercial banks or overnight reserve. And they should be used as a place, according to Investopedia, as a place to park money before investing elsewhere or uh, and anticipate cash outlay. Mhm. Or making an anticipate cash outlay. They're not suitable for long-term investment. And this money market fund, which after all they are debt-based financial instruments, they invest on bank acceptance, short-term debt issued from commercial bank, saving or the certificate of deposit, bank issued saving certificates. Basically, the bank is that issue this certificate. Okay, it's like a promise. So bank saving, so bank, okay. Mhm. Mhm. Mm. Okay, so this money market fund is because I'm making while you are looking at me here, act like an artist, like an autist, or disconnect from this reality sometimes, is because I'm making all of this connection in my head. It's like very, very, very interesting. Okay, 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 okay. So this money market fund, according to Wikipedia, should be used as a place to park money momentarily or temporarily before investing elsewhere or making a cash anticipate outlay. So this debt-based financial instruments invest on bank acceptance, short-term debt issued from banks, commercial banks, savings or certificate of deposit. So after all, so the name, the financial name of this is certificate of deposit. hmm Certificate of deposit. So bank issue savings certificates with short-term maturity. Uh, Commercial paper, unsecured uh, debt from companies, and repurchase agreement or repo. Short-term debt, short-term government debt. Mhm. Interest. Okay. So again, this is one of the financial instruments that allows company to earn interest from keeping their cash in or in a saving account or in this debt-based financial instrument, money market funds, and the like. And the expense and the interest expense is the money that a company need to pay for money they borrow. So some income statements show interest income and interest expense separately. So some income statement combine the two numbers. The interest income and expense are then add or subtract from the operating profits to arrive at operating profit before income tax. So some statements show the interest income and interest expense separately or together. The interest income and interest taxes. So the interest income and expense are then add or subtract from operating profits to arrive at the operating profits before income taxes. Okay, and finally, to the operating profit before income taxes. For example, if I look at Coca-Cola here, the income statement from Coca-Cola, right? The income statement. So we have total revenue or the gross revenue. Right after that, we have the cost of revenue, how much money a company spend to make product and service uh, that are to be sold. Then once you deduct the cost of revenue from the total revenue or the gross revenue, you arrive at the gross profit. There is a section here that you have is the operating expense, where is all the expense related to the company's operations that allows your business to run, such as administrative salaries, research, the cost of researching, for new product and service, marketing, and then uh, you reach at the operating income here. Once you deduct the operating expense from the gross profit, operating income, and this operating income, after that you have is the interest income and income expense. So interest income is money that a company makes from keeping their cash in a saving account, for example, or money market funds and the like. Money market funds involve the purchase of large volume of very short-term debt products such as uh, commercial paper or overnight reserve, and they should be used according to Investopedia. This web media financial service, headquartered in New York and founded in 1999. Uh, so this Investopedia, right? According to them, they mentioned that this uh, money market fund should be used as a place to park money temporarily before investing elsewhere or making an anticipated cash outlay. These are not suitable for a long-term investment. Okay, cool. Cool. So this is interest incomes, and then you have is the interest expense. So the amount of money a company uh, have to pay for money they borrow. Okay, other income expense like this before uh, income tax, right? So you have here is the pre-tax income. All right, and it's funny because they don't mention here anything related to the they don't mention anything related to the depreciation, which is something very very important. All right, very 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 important, like that. And yeah, so finally income taxes, right? So the interest income and expense can be depend on the income income statement can be set separately or together. You can see them separately or together. So for example, here the interest income, yeah, the interest income and interest expense here are separate, right? So Yahoo Finance show that like that. And then you have is finally the income tax is deducted in the what the then you reach here the finally the income tax is deducted and you arrive at the bottom line net profit or net loss. Finally the income tax is deducted and you arrive at the bottom line. The income taxes is deducted net income from continuous interest income interest expense like this pre-tax income tax provision net income statement. They add another expense here, total expense, net income, normalized income, interest income, and interest expense. reconciliate cost of revenue, reconciliate depreciation. Here is when they take in consideration depreciation, net income from continuous operation, total unusual item excluding tax rate for calc, tax effect on the usual items. Tax provision. Here they're including is this earning from equity interest, the special income charge. So finally, income tax is deducted and you arrive at the bottom line, net profit or net losses. Net profit is also called net income or net earnings. This tells you how much the company actually earned or lost during the accounting period. Did the company make a profit or did it lose money? Earning per share or EPS. Most income statements include a calculation of earning per share. This calculation tells you how much money shareholders will receive for each share of stock they own if the company distributed all of its net income or net earning for the period. To calculate EPS, take the total of net income and divide by the number of outstanding shares of the company. Again, it will distribute all of the net income. How much money or how much money shareholders will receive. How much money that shareholders will receive if the company distributed all of its net income. And finally, income tax is deducted and you arrive at the bottom line, the net profit or net losses. And net profit is also called net income or net earnings. And this tells you how much the company actually earned or lost during the accounting period. Did the company make a profit or did it lose money? So, with that, that'll be all for this video. Take care.